Hello my fellow freedom builders and welcome back to the channel. Today I'm gonna make a short video about the platform MyStockScanner. As you know, we have launched the new MyStockScanner platform here, and many of you have had some questions about the valuations tool. So I'm gonna go through that today, and the case stock today will be the Coca Cola company. You all know it, and the question is it good value? Some of you might say it might be because Warren Buffett has a lot of it, and Warren Buffett is a value investor. So let's see if Warren Buffett's Coca Cola stocks is actually good value, or if he, at least in our system here, should look for something else. First of all, we have the summary page. As you know, we can see that it is a very good quality. That goes without saying down here. Return on capital, return on equity, and excellent operating margins. We can look at the PEG ratio. That is actually decent. That is the PE ratio divided by the growth. We do like that down below 2, but 2.7 in a huge company like this, that is not a growth company, is actually very decent. We can look at the earnings per share. That is clocking up nicely here with a bit of a downturn here in 22 and also in 2020, but then the estimates for the next couple of earnings reports are actually fairly decent here. 12% up and 7% up, that is okay. We can see that when we go down here, they have a decent free cash flow, and we can go into all sorts of numbers here. The good question is it good value? So we're going into the valuations tool here, and in here we find a number of different ways to evaluate a stock. We have the earnings, free cash flows, price to sales, and so on and so forth down here. I will be focusing on earnings because it is the most simple. And some of you, if you are seasoned value investors, you might think that this is a bit too simple of a way to look at a stock. But I hope after the video today, it will make sense for you, because all I'm looking at when I'm looking at the earnings here are only two things. And that is, at least if you are a beginner in value investing, or maybe you are a technical analyst, but you do like to do your technical analysis on some good solid stocks that have a lot of growth potential over the next couple of years. Well, then you only need to look at two things. You need to look at the earnings, that is the earnings per share, meaning how much profit is a company making for each of the shares you're owning. And then you're going to look at the price earning, meaning what price are the investors willing to pay for the profits the companies are making. For instance, if a company is making $1 per share, and the investors are willing to pay a price earning on 10, meaning they are willing to pay $10 for each $1 of profit, meaning they are getting 10% in yield on their money, well, then the stock price will be $10. Because $1 in profit, the investor is willing to pay $10 per $1 profit. That is 1 times 10, that is $10. So in this case, it's not $10, but that was just to show you how it works. Now, what the problem here is, of course, we're talking about the future. So we don't really know for sure what they're going to make from on the profit side, and we are not sure what the investors are willing to pay in price earning. But with a company like Coca Cola companies, the analysts are fairly fairly well grounded here in their analysis work, because the stock has been around for ages. It's a very solid company, and there are not many surprises. It's not some new tech. It's not something that has never been seen before. The question is, can they keep growing? So when we go down here, this number here is the number of years we're going to look back. The default is 10 years. I'm not changing that here. Future years to calculate. Well, I'm using 2, but that is because that we have, for most stocks, the next 2 earnings reports in the estimates here. So we have the one here around New Year 23, and then we have the one around New Year 24. So it is only a year and a quarter, but it is good enough. The risk-free rate here, that is the gray line, meaning that depending on what you can get in a risk-free interest rate in your bank, for instance, let's say that is 3%, well, then your stock should preferably give you more than that, because otherwise you might just choose a risk-free bank account somewhere. All right, so we have set this to 2 years. I'm removing the include analyst estimates here because I want to put something in myself. But if the analysts are right, if, for instance, the stock per year over the next couple of years is going to grow its earnings by 7% per year, and the investors are willing to pay a price earning on 26.6 here, well, then the next 5 quarters, the Coca Cola stock should go up by 16.2%, which will give you an annual return of 12%. That is actually very, very decent. It has gone sideways for a while here, actually since back in New Year 21. So that is almost 2 years it has gone sideways and actually dropped a bit here. But they have kept growing their earnings, or at least the latest one here was minus 2.6%, but the estimates are fairly good here. So what we can say here is we want to take an average of this, 7 and 12, that is 19 together, so that is 8.5. Let's just put it at 8. Let's say that Coca-Cola is going to grow its earnings by 8% per year the next couple of years. Now, if that is one of the factors, that is the earnings. If we are right here, then the Coca-Cola is going to give us a 13.8% per year in annual yield on the stock, 18.5% altogether. Now, this 26.6, is that a fair price earning? Well, not many companies have been as consistent as Coca-Cola, I would say. We can see over 20 years it's around 30, over 10 years it's around 40, over the last 5 years it's around 28 here, and 28. So 26.6 is actually probably fairly accurate. But if we want to say we think they can go for the average for the last 3 to 5 years here, we can choose the 28.5. If the investors are willing to pay that, and if Coca-Cola is growing by 8% per year, then over the next 5 quarters, Coca-Cola should go up by 27.2%, giving us 20% per year. Now, this indicates that Coca-Cola right now is actually a decent value stock, I would say. Of course, it all depends if we get it right, if we get these numbers right. Because what if they only grow by 5%? Well, they will still go up by 20% the next 5 quarters. What if they don't grow at all? Well, they would still rise 9% if the price earning is 28. So even without growth over the next 2 years, Coca-Cola is actually still a decent stock. Now, what if the PE goes down further? We can try and put in a 26 as we did before. That would be almost a break even. If it dropped to 23, that is lower than any numbers the last 30 years here. Then the Coca-Cola would drop 12%, but that is not a massive drop, and that is without any growth, and it is with a lower PE than have been seen for ages. So I would say that Coca-Cola right now is actually a decent stock to buy. If we can get it at a price earning around 27, and if they don't grow at all, we will be basically in break even over the next 5 quarters. And for every percentage they can grow their earnings per share, let's say they could grow by 10%, well then we would have a very, very decent investment on our hands. So the question is Coca-Cola a good value stock right now? Well, that is up to you to decide. Are my numbers here completely off? Are there something we haven't calculated in here? It could be that when we are doing our research, we find out that there is a company that is facing a huge lawsuit, or maybe they are facing some legislation in some countries that we think will be massively expensive for them. It could be that, let's say, it was a mining company that had their mines in a very unstable country. It could be an African country, and it could be in the Middle East. It could be in South America. It could be whatever, where some countries could maybe nationalize the mining sector or whatever. It could be all sorts of risks that we can put in here. But if we are right about our estimates about the earnings, and if we are fairly right about the price earning down here, the earnings per share and the price earning here, then we have a very, very good idea of where the stock will be in the future. And then, of course, we can take it out further, because this is only the next 5 quarters, the next 2 earnings report here. But we could look out 3 years maybe and say, okay, what would it give us if they grew by 5%? And maybe had the average over the last 3 years here, well, then they would grow by 26%. But the analysts are actually estimating that they can grow quite a lot more. What if they could do 7% over the next 5 years maybe? Well, then we would have an investment that would yield us around 53%, giving us 10% per year. That is actually a very, very good investment. Then you could put other considerations into it and say, all right, we might go into a recessionary investment environment. So what do the investors do there? Well, investors tend to go for some very solid stocks when it comes to recessions. We have the higher interest rates and so on. So the investors tend to go a bit away from the risky growth stocks and more into the more consumer goods, easily cheap consumer goods, utilities and so on. And Coca Cola is definitely one of the companies where you could say it is what is called almost affordable luxury. Even if you have almost no money, you would still have money enough to buy some Coca Cola. So play around with the numbers here. Remember, you only need to adjust 2 different handles in this equation here. You need to look at the earnings growth and get that fairly right. And you need to look at what price earning will the investors be willing to pay. That's it. And if you get these 2 just fairly right, you don't even need to get them completely right, but you can get an idea of what if the estimates are completely wrong. Is it still a decent investment? And if so, well, then you could actually go in and buy it without too much risk. But again, remember, use your own risk management, use your own strategies, put some technical analysis on the stock as well if you want to. This is just to explain how the valuations tools work when we are looking at the earnings. I hope this made sense. If not, feel free to write me the answers underneath the video here in the text section. That's all for now. Take care of yourself and your money out there, and I'll speak to you again shortly. Bye.